Welcome friends, and thanks for taking the time to watch this video. I've been able to participate in some really amazing seminars recently, and I wanted to be able to share this information with you. So I've put together a video that hopefully will give you some idea of what to expect in the housing market in 2023. Before we delve in, let me just remind you that as much as possible, I'm trying to keep my opinion out of this presentation. I want this to be what economists and data scientists are saying you should expect, not just what I hope for you in 2023. Looking back at 2022, we had another big appreciation year. Not as big as 2021. Through the third quarter, it was at about 10% appreciation. And that wasn't a straight line appreciation. That was a bunch of appreciation in the first and second quarter and a little bit less appreciation in the third quarter. So the question then is, what happened in the fourth quarter? I won't have that data for you until February when FHFA puts it out, but we can make a pretty good guess based on sales data from RMLS. So in those 3 months, we saw prices decline by less than 1%, and that's pretty typical for that time of year, independent of market forces. So taken together with the 10.1% through the third quarter, expectations then are that 2022 in Eugene, Oregon was probably 9.6, 9.7% appreciation, which would put it the fifth highest appreciation in the last 20 years. So pretty great investment. I don't think there were a whole lot of other investments that did so well in 2022. When we look at expectations for the upcoming year in terms of the housing market, I'm going to focus on three of the biggest influences. That is inflation, housing availability, and housing affordability. In particular, mortgage interest rates. That's a real hot topic right now. And then at the very end, we'll talk about if we think this represents a crash similar to 2008. Spoiler alert, it doesn't. Inflation's not always a huge part of the housing market, but it certainly is right now because it's pretty high. And the Fed was very aggressive last year in trying to decrease inflation. They were somewhat successful. They got it down from that 40-year peak that we saw in September of 6.6%. In December, it was down under 6%. But most people think the Fed expected stronger declines with all of their Fed fund rate raises from last year. And their target is 2% inflation. And so that sets up the expectation of more fund rate raises in early 2023, and the possibility that that will lead to a shallow recession early this year. Availability. We're going to talk about months of inventory, and if you haven't talked about this in a little bit, let me just remind you that the idea of months of inventory is that if we got no new listings, this represents the amount of time it would take us to sell all of the things that are currently on the market. So from experience, we've determined that 6 months of inventory represents a pretty balanced market. And if we have more than that, that means that buyers are being picky and choosy. They have plenty of things to pick from, and that is a strong buyer's market. If we have less than that, then things are selling quickly. There's sort of an air of urgency, and that's a seller's market. Buyers are competing with one another to try to get the few houses that are for sale. If that sounds familiar, that's because that's the market that we've seen here for quite a long time. Looking back at the last 3 years, you'll see that we have barely even been in the 2 months of inventory, so it's been a pretty strong seller's market for the last number of years. And then of course the question is, do we expect that to change in 2023? To get a gauge of that, economists look at what's been going on in terms of new construction. And so the last time in Oregon that we built enough new houses to keep up with population growth was in like 2006, 2007. And you can see it took a big dive during the Great Recession. It's recovered, but it hasn't gotten back to those pre-recession levels. So we've got a housing shortage. That is not something that we expect to change anytime soon. So let's then take a look at affordability. This is not an EKG. This is a graph of average 30-year fixed mortgage rates in the US since the 70s. My question to you is, which part of that graph represents a normal real estate market? That's a trick question. There is no normal real estate market. Let me point out a few really important aspects of this graph. So if we go back and look at the decade in which I was born, the 80s, that was, of course, the era of extremely high interest rates. And since then, there has been a concerted effort to try to decrease those rates. And you see that to greater and lesser degrees, we've been successful at doing that. This red line is about 6.5%. That's about what interest rates are right now. Those vary on a daily basis, of course. But then we go back and we look at 2008, and you'll see right after when that recession kicked in, there was a pretty steep decline. So if we put ourselves back in that time frame, of course, we had a glut of houses for sale and people weren't buying them. So how do we address that? Well, we make houses more affordable, right? And so since 2008, it's been in the interest of the overall economy to keep that interest rate low so that people would go out and buy homes. I think we can all agree that they've been doing that. We may, though, have found the bottom of where that makes sense in the last couple of years as interest rates have started to go up again. In fact, this period of interest rate growth in the last year is the steepest that we've ever seen in recorded history. So naturally, people have a little bit of interest rate shock, is a term that you'll hear out there a lot. It went up a lot in a very short period of time. That's hard for people to adjust to. When we think about what's going to happen in this year and going forward, opinions vary somewhat. Most economists think it will decrease to some extent. Some economists are a little bit more pessimistic. This red line is the National Association of Home Builders. And then on the bottom here are Mortgage Brokers Association. They're a little bit more optimistic. The average of predictions is that by the end of the fourth quarter of 2023, we'll be under 6%. So is this 2007, 2008 all over again? Well, what's different, a huge difference, is the amount of equity that people have in their homes right now because of all of that growth that we've experienced in the last few years. In fact, the national average is $300,000 in home equity. Here in Eugene, we're at just a little bit less than that, $288,000. But that's incredible. When I started in real estate 8 years ago, the average sale price was $285,000. Now people have more than that in equity on average. So that is a very big safety net. And in fact, to get back to the levels of negative equity that the country experienced in 2010, prices would have to drop over 40%. Pretty unlikely, especially when you look at what we've just talked about with the housing shortage that is unlikely to go away. So is this the Great Recession all over again? Absolutely not. There may be another housing recession on the market. I can't tell you that for sure. My crystal ball is not any clearer than anybody else's. But I can say unequivocally that pretty much every one of the factors that caused the crash in 2008 is different today than it was then. So we had too much inventory, now we have too little. We had predatory lending issues. Now we have much better standards. We don't have all of those adjustable rate mortgages. We don't have as many cash out refinances. There isn't the buildup of people in delinquency. And in general, the outlook of investors in real estate is much more long-term than it was in 2008. Now, I said at the beginning that these weren't my opinions. This is the place where maybe that is the least accurate. I do want to give you some sense of what I make of all of this data. And of course, opinion does enter in then. I think that there's going to be an adjustment to the interest rates that we currently see, whether they're 6.5%, 7%, 6%, wherever they are. I think they're going to stabilize, and so we get used to whatever our current situation is. We saw that when we had those extremely low interest rates for several years. All of a sudden they went up to 4%, and people panicked because that seemed like a really big increase. So as those interest rates stabilize, buyers will get used to it, and then I think we'll be much more comfortable continuing to invest in real estate. Demand should stay higher than supply. I don't see any change in that that will happen immediately. And one economist, in summary, said that she expects home prices to return to long-run average, what she called long-run average. And if you look back in Eugene-Springfield, that's about 5.5%. No one knows what the future will hold. I'm hoping that this presentation gave you a little bit of a sense of what economists are expecting in the coming year. Of course, these are averages. These are generalities. I'd love to talk to you about your specific situation. If you think it could be of value, give me a call anytime, send me a text message. I'm always here for you.